Singapore posted a stronger than expected GDP performance in the third quarter, according to advanced estimates from the Trade and Industry Ministry. Driven by better performance in manufacturing, finance and wholesale trade, the economy grew by 5.1% year-on-year in the 3 months from July to September. The market was expecting 3.8% growth. Across sectors, manufacturing grew by 4.5%, driven by better output from the electronics and transport engineering clusters. Construction is up 3.6%. Services expanded by 5.7%, boosted by the finance and wholesale and retail trade sectors. On a quarter-on-quarter basis, economy contracted by 1%, less than the 4% decline the market was expecting. The government is expecting Singapore's economy to grow between 2.5 and 3.5% for this year.
It's all overall in line with that growth is improving, but albeit on a very gradual and still very fragile sort of momentum. We would like to think the domestic-oriented sectors should remain resilient, while hopefully the external demand picks up. So because the domestic sector already has some high base, we will need the externally oriented sectors to pick up to mitigate the slack.
And to help us crunch these numbers, Joey Chu from Barclays is in studio with me. Joey, thanks for joining me. Now, the economy shrank by 1%. It's a stark contrast to the 16.9% expansion in the previous quarter. Now, how are workers and business likely to be affected?
Well, now, first of all, I would just say that Singapore's economy is always subjected to some volatility in growth, right? Being very small. And I think we need to take the growth contraction in Q3 into the same context with the expansion in Q2. So looking at, in both quarters, I would say that growth has been very resilient and very good, and that has translated into, steady job gains for the consumers and then, steady profits for businesses as well.
And it actually, year on year, it actually beat market expectations.
Yeah, that is correct. I think the key reason for these upside surprise is really the services economy did much better than expected. If you look at, even though we had some, financial market volatility, and some of the ASEAN economies also did more poorly, which affected our trade-related sectors. I think if you look at domestic-oriented services, I'm talking about healthcare, education, and even personal services. I think these sectors continue to do very well, given the tight labour market that we have.
Yeah, I mean, it was described as a wild card, wasn't it? So it was a bit of a surprise that it's done so well. So do you think it will continue to do well with the tightening of the labour market?
Yeah, I think so. Insofar that the labour market remains tight, I think this will eventually translate into stronger wages and therefore stronger spending by consumers, and that will support the domestic-oriented services.
Now, other sectors that did well include manufacturing and construction. Do you think that will sustain?
Well, the manufacturing outlook, I think, really depends on the situation with the US right now, right? Because the US is behind, I think, the growth impetus that we had so far, and whether that can be sustained really depends on how the situation of the US fiscal impasse and even the monetary policy really pans out in Q4.
Now, the growth forecast for this year is a range of 2.5 to 3.5. Do you see us hitting the upper end of this range?
Yeah, actually, just year to date, averaging the growth in the first 3 quarters, we are already at 3.2%. So I think there's a very strong chance that we will be at the upper half of this forecast range. And that much depends on whether our exports continue to grow in Q4.
What about other risks like higher business costs with rising inflation?
Well, yeah, that is certainly a part and parcel of stronger growth, I think, that we have higher business costs. Also, considering that the labour market is already tight, the government's tightening immigration policy, I think we should expect labour business costs in general to further increase and putting more pressure on inflation next year.
All right, Joey, stay with us. We'll come back to you after our next story.
Okay.
As many economists had expected, Singapore's central bank has kept its monetary policy unchanged in its October review, allowing for modest and gradual appreciation of the Sing dollar to contain inflationary pressures. In a statement, the Monetary Authority of Singapore noted that the pass-through of domestic costs to prices of consumer services could intensify as a result of rising business costs, including rentals, COE premiums for commercial vehicles and labour costs. MAS expects headline inflation to come in at the upper half of the 2 to 3% forecast range this year. Meanwhile, core inflation, which strips out housing and private transportation costs, is projected to be 1.5 to 2% in 2013. Economists say the latest stance implies that the MAS is more concerned about inflation risks as opposed to potential downside risks to economic growth.
What we've seen is that the balance of risks and their focus is shifting somewhat towards the rising labor costs concern, because I think they're quite comfortable that growth momentum is still being maintained. The great issue, I think, over the medium term for Singapore is how to address boosting productivity growth, because that's the key to keeping unit labor costs down and inflationary pressures low.
So, Joey, it looks like no change in monetary policy. Are you confident that inflation will be contained?
Well, I'm afraid we still expect inflation to rise next year. Certainly, the appreciation policy will help keep imported costs at bay. So we're already seeing, some rise in global commodity prices, and I think the exchange rate stance will continue to keep that tempered. But unfortunately, domestic costs, I think, is the key root of the inflation rise into next year, and I'm afraid the exchange rate policy has limited influence over that.
Now, speaking of that, the strong dollar is good for the Singapore tourists, but there are downsides for business exports, no?
Yeah, that is true. It might affect our competitiveness. But I think, this is necessary if we want to keep inflation in check, because, stronger growth above potential will only raise inflation further.
Let's look at more macro issue. Now, the IMF has already cut growth forecasts due to uncertainties in the US. Now, how do you think this will affect Singapore, and what can the authorities do? What options do we have?
Well, yeah, Singapore being the most open economy in the world is definitely, I think, at hostage to what's going on in the US right now. Certainly, if the US economy does, hit a bit of a pause, given the situation right now, the US fiscal situation right now, I think Singapore's growth will also be affected. We might see growth contract in Q4 even, if exports do not pick up. But I think the Singapore government has some tools available to support the economy. For example, I think construction will continue to do well, given that a lot of infrastructure spending is already on the cards until 2020 even. The railway infrastructure that we're trying to build.
All right, Joey, thanks for those insights. Thanks for joining us.
No problem, thank you.
And that was Joey Chew, regional economist at Barclays, on the potential impact of Singapore's monetary policy.